Is it a struggle? Yes, we have to realize our strengths and our weaknesses. Hi, and welcome to Why Not? And I'm your host, Janice. We're here helping others to reach their goals by interviewing inspiring guests with motivational topics to get you where you need to go. Today, our topic is getting financially sound during an inflationary period. One note, the content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Now, we're going to start with, we have a wonderful guest in our studio again, Susan Pfeiffer from Newmark Credit Union. She's been on the show before talking about getting financially sound with getting your credit going, being able to get mortgages, and just understanding basic information of what you need to know to help improve your financial life. Welcome to the show, Susan.
Hi, Janice. Thank you for having me. So good to be back.
Thank you for coming back on the show. Really appreciate it. Today's topic that I talked about was getting financially sound during an inflationary period. This is January 2023, start of 2023, and everything is just outrageous going to the stores and having to have savings to even pay for eggs, which have pretty much have gone up 500% almost from 99 cents to $5. So wanted to get some information from you, like what can we do to prepare ourselves that we're going into this period, which we are now, to get financially sound? Where do you think the first start will be at?
Well, that's a great topic and a great question. So, the first thing that I think most consumers want to try to pay close attention to is where their credit is. That would be the first thing I would say to focus on, try to figure out where their credit score is. They may need to do a little bit of credit counseling if they're not, where they need to be financially as far as their credit score to get an approval for a mortgage. They might need to work on some items. Maybe they have some past medical collections that they need to get cleared up, or they may have some credit card debt that they're working on tackling. But that's what I would say the first and most important thing is what do we need to do and focus on your credit? Is there anything that we need to work on? If there's a lot of credit card debt, then I would say let's focus on trying to tackle some of that, try to get some of that paid off so you're not getting into a new mortgage or getting into a new home, not knowing, what could happen with the home as far as repairs and things of that nature. And if you have a lot of credit card debt going into something like that, well, then you could almost be putting yourself in a bad position right from the start. So I would say the most important thing is, talk to somebody, find out where do you stand credit wise? What kind of credit rating do you have currently? And what is on your credit? And what do we need to take care of before moving forward?
Okay, so worry about their credit. Now, should they also budget? Is that necessary too? If they're going to be paying off their credit, I mean, I guess they need to figure out what's exactly where they're at status wise, credit, debt, and then budget or work on the credit.
I would say the budget is almost equally as important while they're working on that credit. They want to sit down and figure out their budget. I
Mm.
always recommend first figure out what kind of budget are you on currently. A lot of people haven't ran a budget to even know what they're having come in and out on a monthly basis. So just sit down with a list of your bills, the expenses that you've got outgoing, whether it's a car payment, car insurance, even those monthly subscriptions that people kind of forget about and they're on the auto
All right.
payment. So make a list of all those things so that you know, okay, this is what I have outgoing on a monthly basis. This is what I have incoming, and this is where I have room to maybe do additional savings. Maybe there's some subscriptions that are not active that they could cancel. And then, even if it's $20 a month, that could be 20 a month that they're then putting into their savings account.
Right. They could either put on the savings account or start paying down the debt.
That
So,
too.
right. And you mentioned a great thing because all those little subscriptions we don't remember. I mean, that we have. I have like the Hulu, we have the Paramount Plus. I even realized that I had a renewed subscription to Barnes and Noble every year. I was like, what? I've been $25. I haven't bought a book in a couple years there. And
So
those add
true.
up.
They
They,
do. And I think many people like you and I forget about them. They're on that auto renew and the payments come out. Many times it's not out of your bank account, it's a credit card. So you're just paying that credit card bill monthly and you're kind of on autopilot and you're not even realizing. I had a similar situation with something from my son that he's 12 now. He used it when he was about 8, doesn't read the magazines anymore. I'm like, why are we paying for this? This is silly. So just kind of making a mental note and making a list of all those things that are what is necessary, what's not necessary. Maybe there's some trips to get coffee every day that you could cut out, and then you could use that money to pay down some credit cards or build up your savings. But that's really, what you need to look at first is just get a really good handle of what you have coming in, what you have going out, and what things can I take care of right now, or try to put myself on a 3 to 6 month plan to say, okay, maybe I can't take care of this today, but if I do these steps, then in 3 to 6 months, I'll have that bill paid off.
now, what about now? You said doing a budget so people know what's going in and out. Should they actually probably go and review like past bank statements or credit card statements? Now, I know I'm bad at it. I do not look at all my credit card statement to see was that charge, my charge, that charge. Should they take time to go back in like the last 3 to 6 months and see what their charges were or what they spent?
Absolutely. I think that's super important. And so many of us don't, pay attention to that, especially not on a daily basis.
Mhm.
So even if you go through the month and figure out, okay, this is what I spent for the month. December probably isn't the best month to do that with all the Christmas shopping and the things that we do,
Right,
but we're
right.
at the beginning of a new year now. And I know a lot of people, even in January, they're still paying off debt from the holidays.
Mhm.
So we have a new month starting. Try to look at it, February, March, and figure out, okay, this is what I have going in every month. This is what I have going out. And you want to think about those things that you don't think about. That's why it's important to spend a little more time on that than you might think necessary, just so you're not leaving something out that you forget about that you are paying. Because some bills aren't monthly, but they're quarterly or bi-monthly or
Mhm.
bi-quarterly, every, twice a quarter, things like that. So you need to take all of that into consideration.
Right, like my gym membership that's getting my wallet thinner than me. Yes, because it's been going to the gym, but not me. Yes, definitely.
Exactly.
Um, Also, like I know some people put their bills on regular automatic payments, such as like even your water and gas bill. Like I'll send a $50 a month to it. Isn't can that be bad too? Because it's $50 every 4 or 5 weeks or on a paycheck. Couldn't that cause extra payments to be sent out?
Definitely. Yeah, the nice thing is, yes, those are convenient methods for all of us when we don't have to think about it, out of mind, out of sight, out of mind, it just gets paid. But that's the whole problem when it's out of sight and out of mind. There's things that we neglect or we forget about, or things that, we could end up making an extra payment on and we don't necessarily need to, like your water bill. Obviously, there's no need to send them an extra payment for that. I would rather see you send an extra payment into that credit card that we're trying to get
Right.
paid down. So that is very important. And it's actually good to go through your bills every month and with your budget in hand and say, okay, this is what I can afford to pay, towards this bill each month. So if you can maybe get away from doing some of those auto pays while you're in the process of getting yourself ready for financial, home ownership, that would be the best thing is just to kind of take yourself off that autopilot and kind of put in the work and those make those good choices and good intentions so that you get yourself ready.
Right. Absolutely. And then, especially during an inflationary period, we actually have to pay attention to those little things we don't write down. The money we spend on cash. If we have $50 in our pocket, we are going to Starbucks, we are going to fast food versus cooking at home. So those are other tips too. Just be mindful on what you're spending your money and write down everything, even the dollars you're spending. You go to McDonald's maybe for $3 or Starbucks for five, that still adds up over time.
Absolutely. There's a lot of good methods in place that you can utilize for budgeting for things like that. One method that's been around for a very long time, and I know that it's been around because it works, is the envelope method. And that's where you write down a list of all your expenses that you would have in that budget, and you make an envelope for each item, such as, rent or housing expenses, and then you have a separate one for your food budget, for gas. And then once that envelope the money is gone in there, you don't get to go out to eat, that month or that week, whatever, however you decide to have your envelopes set up.
Mhm.
But that method has been around for a very long time because it works. As long as you stick to it, it definitely works. So that's another great idea is once you get your budget in place, get a stack of envelopes and label
Mhm.
everything and then try to take the cash out of your paycheck, put it in there, plan accordingly and try to live off those envelopes.
Okay. Now, what's the next step? Now, I know we've already looked at the credit report, so we know what our debts are. We've created a budget now, and we're actually tracking everything we spent, the prior months and the current months, to see exactly what we're spending. Is the next step to, would you put more emergency savings or will you start paying down the debt? What would be the next step?
Well, I would say that paying down the debt, anything you can pay down is going to be important. That would definitely be a goal. I would say try to knock out anything that you can. There's going to be some things that you might not be able to, whether it's, student loans, if it's a car payment, something like that, you might still have. And there may be some credit card debt that you might be going into the purchase with, and that's okay. As long as you know now that we've made our budget, this is what I can afford to spend on a monthly basis. What does that look like? Maybe you qualify and you can afford to spend a $1,500 a month of your income towards your housing allowance. Or maybe you need to keep it closer to 1,000. But that number is so important. And that's why it's good that we go over the list so we can kind of calculate and figure out, okay, this is where I can be monthly. So then once we have that number, you get the credit card debt, you're trying to chip away at that every little bit that you can. Then we want to focus on that savings. And I would say that probably starting with, a goal that's attainable. Start with $2,000. And then once you get $2,000 saved, then you want to save another 2,000. When I first talk to clients, I usually tell them, and it doesn't mean you have to have $10,000 in the bank, to buy a first home. You don't. But if you can set yourself a goal with something like that, like 2,000, then 2,000 more and try to work towards $10,000, you'll probably reach the goal quicker and easier than you may have thought possible, especially if you're sticking to the budget.
Right. And writing down those goals too would be very helpful. Not just putting it in your mind, but actually being able to see it, you know. Yes. I have another question to go back to the credit with paying down the debt. Does it make a difference when a loan officer is looking at, okay, I have a J.C. Penney, I have Sears. Oh, forget Sears. We know they're gone. I have Macy's, I have Credit One or Capital One, all those things. Does it look better to pay off the ones that have like the monthly payments that are like $300, like a car, get rid of that versus having like 10 credit cards? Does that affect you? Or is it just the total amount paid off per month?
That's a great question. So at the end of the day, the underwriters are really kind of looking at what your monthly debt is, if you will. There's certain things though that they can actually not have to factor into that equation. So you mentioned the car. One thing that I can bring up about a car, if you actually owe less than 10 payments at the time when you're going to purchase a home, we will not consider that car payment into the equation. And it's
Oh, okay.
basically because we know within the next year, and you do get to skip right after you close to purchase the home, you don't make a payment initially, you get to skip a month. So that's taken into account too. You've got 60 days basically after closing that you're going to be making that first payment within. And so you have a little time where you can send an extra car payment in. So we don't factor in any auto debt that's going to be less than 10 payments. If
That's
it's a lease, it's a little bit of a different story because they make the assumption that you're going to go out and you're going to get a new lease.
right.
But an auto loan, that's something that I will tell, consumers if you're trying to pay off an auto debt, even if you can rather than pay it off, let's get it down to 10 payments and then we don't have to count that into the debt to income ratio.
Ooh, that's good information. I did not know that.
Yes.
I have my godchildren and they're thinking about either refinancing or up into a different house. And they're like, we need to pay the car off. I'm like, no, you need to at least pay it down half and then worry about, putting a little bit of savings aside. So then you'd have some emergency fund. So,
Absolutely. The emergency fund is so important. And, in regards to that, if you think you're going to be in a mortgage where your payment is, let's just say 1,000 to make it easy, the first goal is after closing, you want to have at least 3 months, I would say, saved up. Of course, you want to work towards more than 3 months, but initially you want to know, God forbid something happens, you have 3 months of that payment saved up in the bank so that you don't have to worry about if you get sick or something, you know where the payment's going to come from.
right, definitely. And that's why I was trying to explain to them. They actually bought their home last year, so we're so happy about that. But they outgrew their house the first day they moved in. They found out they were expecting again.
Oh, congratulations to them.
Yes, we're happy about that, but it's like now gotta get the credit back in savings again. Now, paying down the debt. Now, most people say pay down the highest interest rate first. But suppose you have smaller bills, like a smaller $100 or $200 credit card. Would it make sense to pay those off before the higher interest rate, or how would you judge that?
So I think you can kind of go about it both ways. To be honest, I don't know that there's a right or a wrong way. I will say, though, that I prefer the snowball method, which is focusing on the small debt first, only
Mhm.
because even in my own personal life, I've used that method and it works. And I've, guided clients over the years and I have seen the success and the results with that method. I think it can be easily attainable. And so that can be a better encouragement too for consumers. If you've got a couple small credit card debts that are, let's just say, under 500, you pay one off, then the idea behind that is whatever you were taking to send in on that card, you send that in on the next one, and then you're able to kind of tackle the cards that way. So that's a really good method. Honestly, that's what I usually will tell my clients to try to focus on first because
Mhm.
it can get, challenging if you're looking at, let's just say, a credit card that maybe is $5,000 to $6,000 and you have a $200 or more monthly payment on that. You're going to have to chip away at that quite a bit before you start to see a difference. Whereas if you get the
That's
small
true.
cards paid and you can throw the money from the small cards onto that $200 payment and maybe send in $500 at a time, then you're going to notice that balance going down much quicker.
Right. And I would also think that would also be just rewarding that, hey, I at least paid off one credit card. There's two credit cards down. Even if they're the smaller balances, at least that sense of I did some type of accomplishment. I would think that would be good too. And that would build that momentum and desires to bring down all the credit cards.
Absolutely. I agree. And that's why I always tell people to try that method first, because as you said, that momentum, that's huge and that helps them attain that goal much quicker.
Now, when it comes to mortgages and credits, and even credit in general, they always say that you should keep your balances below 30%. Do you think people
Yes.
take that into a factor? And is that really a good method to do to help boost your credit score?
I would say that honestly, I don't think all people take that into consideration. And I wish they did. I wish there was a disclaimer that came with those credit cards when people took them out so people understood, because I don't think many people do understand that, many people don't have credit cards. So the first step is they go and they apply for some credit cards, they get them, but then they're out shopping because they think they need to use the card, which is true. That's important. But then next thing you know, you have a $300 credit card balance and you owe $295, and that will actually lower that credit score. So it's important that
Mhm.
you get the credit, that you use it, but that it's very important that you use it properly. So you kind of have to retrain that brain of yours and say, okay, actually, no, my credit limit is really 30% of whatever I was approved for. And it's just about retraining your mind to think that way. And then you don't let your balance exceed that amount. And you should still use the card then and use it that way. And then they will see that the score will start increasing very quickly, and it goes up pretty quick. Within 2 to 3 months, you'll see a rise of your score, definitely, if you use it properly.
Now, do other things like utilities play a factor in your credit report or for getting a mortgage? Because not a lot of people, like you said, have credit cards, you know. Um, so would that affect them also, the utilities, if they're paying those on time, cell phone bills? Does that help at all?
That's a great question, and it can. So, all utilities are not automatically reported to the credit bureau. It is something considered a self report. So, the consumer actually does have to reach out to the credit bureaus, to TransUnion, Experian, and Equifax, and they are voluntarily agreeing to allow that information to be self reported, is what they refer to it as, on the credit report. So, it can actually be built on the credit report and help your score go up. It's a great
Oh,
idea for
really?
people, especially people that don't have a lot of credit. That is one of the first questions I would ask, and I would say definitely try to get that stuff on your credit. That will definitely benefit you.
Wow, I had no idea about that, that you can actually contact them to actually the credit bureaus to see about putting your utilities on. That would be great for some people.
Absolutely. It's a great thing, great tool, but a lot of people don't know about that. And equally important, if they are currently renting, that rental history can play a big part in getting you approved for a mortgage too. If you've been renting a home for a year or anything longer, of course, that's going to all be factored into your approval. So that's all very, very important. It can get tricky in a couple situations if you're paying cash and maybe you're paying mom. that can be obviously,
Mm,
a little more difficult to prove that you are paying mom that money every month.
mm,
But I always say, if you have a question about it, talk to somebody that can help you and figure out, hey, can this be counted? Can this be used? Or maybe how can we go about doing it in a way that in a year from now it can be considered if it's not currently?
okay. Now, is it a plus to have a checking and a savings, and especially having a checking and savings at the same branch or something that you're going to get a loan from, like a credit union or a savings and loans? Is that a plus?
I would say it's a benefit. It definitely can help, but I also would say that, there's not going to be any discrimination if you're not in any way.
Okay.
So, some people just have a checking account and that is all that they use, and that's perfectly okay. Some people do like to have a checking and a savings, and that's great if that's how you budget. Either way, there's not really a right or wrong answer there as long as they're, doing what they need to do to be saving their funds and paying their bills on time. I would say either option is okay. But banks, lenders, credit unions, any of the above, they can't just say, oh, because you're not banking with my institution, we're going to have a hard time getting a mortgage for you. That wouldn't be the case. I'm
Okay.
sure it's a maybe an added bonus or a benefit, but it definitely isn't going to be a hindrance for someone if they're not.
Okay. Okay. And then I would think smaller places like credit unions are more personalized versus the big corporate banks also. Do you find it more that you get repeat customers or people that just feel more comfortable being at a smaller branch?
I do. I think so. I think there's that added level of service that I'm not going to discount anything any other large institution is doing, but when you become so big, that's just the thing. You become so big, and when you work with a smaller company, there's one of those the saying about less hands in the kitchen kind of thing, and it's very true. And that's even during the loan process when you have less people working on your file. It's easier. It's easier to tell your story when there's not 15 different people looking at it versus there's, three or four people making that decision. So I do think that there's a personalized experience that you get going with either a credit union or maybe a small local community bank, something like that too. But I definitely feel there's an added level of service that people are getting that you wouldn't get elsewhere.
Okay. I had another question that's pertaining to savings and when it
Okay.
comes to mortgages. Now, when you have to show, say you want to get a loan and you are going to show you have 10% down payment or 10% reserves. Does it have to be liquid? Does it have to be cash? So if you show that I get 10,000 in stocks and bonds, how does that work?
That's a great, great question. So it doesn't have to be liquid. We have to prove that it can be liquid. So if that's where the money is coming from, we need to see the terms that will make those funds liquid. That's basically what will be required. And there's many different ways to get the down payment. There's gift funds available if you have a family member that's able to do that. Many of the programs allow for gift funds. Many places, if you participate in a retirement or a 401k, you're able to pull from that, especially if it's your first time purchase. I
Mm,
would say everyone needs to
okay.
reach out to their individual account planner for their retirement and find out, what they will allow because there's different rules, of course, governing
Mhm.
each program. But
Right.
there's grants available for down payment. So there's many different options, but you don't necessarily have to have the money liquid. However, I would say before you get a gift from, grandma or grandpa or somebody that can help you with that down payment, talk to a lender about it because sometimes what we find happens is someone will get a deposit and let's just say it's $10,000 and whatever family member gave the money, there is some obligation for them to provide documentation to support that deposit when they're going through the loan process. Unfortunately, what we find sometimes is once that money is given, then whoever the family member is, they may not be comfortable with sharing their personal account information to
Mhm.
fully, source that deposit that they've gotten. Then we're kind of in a trick bag because now we have to figure out, okay, they have the money, they just can't use the money. So how do we get around that? So
Okay.
it's always a
Right.
good idea to talk to a professional first and make sure this is where I'm going to get the money from. I want to talk to you about it and make sure is there any special thing they need to do. I always say, if it will help, I can have a conversation with your family member. There's documentation that can be sent to support that you're not just going to send it to anybody and why you're asking for what you're asking for because
Right.
that's usually what it boils down to is they want to know too. That's all their personal information that it's being sent somewhere secured. It's not going all over the
Right.
place.
Yeah, definitely. I help my son out and they like, well, I want to know where you got the money from. I'm like, what? And they're like, well, I want to see your bank account. I'm like, why? Like I was kind of taken offhand because of that. I didn't realize like what, I guess they have to find out the trail kind of sense, where the trail goes. And is it a loan or is it a gift actually? So it was like that part I didn't understand. And that did send me off guard. So it's great that you tell your customers that up front.
Definitely. A lot of things can be avoided just by having the conversation up front if you make sure that, you explain all those steps. That's something very, very important. And not to say that there's not ways to figure out how to get around it if you run into a situation like that, but it's much easier to navigate from the get-go if you have that conversation up front.
Okay. Now, I guess we're getting closer to the end, but getting back to with cash or liquid. Like I know a lot of people have started like the Acorn accounts. They have Robinhood accounts, I think it's called. So could those also be considered as cash since they can be able to cash them out? But do you
Yes.
count they're going to have a tax penalty? Do you count that too?
Yes, that's a great question, Janice. So any of those that they will receive a penalty, they will account for like a 30% basically penalty for that. So meaning they'll count 70% of the balance. But otherwise, if it's just your stocks that you can sell, you definitely can use that. Something that's going to be coming up around the corner is your IRS tax refund. I always tell people around tax time, people don't think about that, but you can use your money that you get from your refund for a down payment as well.
Okay, so it doesn't have to be seasoned. I think we have 2 minutes. It doesn't have to be seasoned.
That's correct. If it's something like that where we can show where it comes from, it does not have to be seasoned. Even if you come back from H&R Block and you show me I'm getting, $3,000 in 2 weeks from now, we can use that.
Oh, okay, great. So this is great talking about this inflationary period. So we've talked about people need to pull up their credits, which I believe they're free typically. You can write to get free ones still.
Absolutely. Myfreecreditreport.com.
Myfreecredit.com. Pull up your credit, see what you got in your debt, write out a budget. And there's budget softwares they can use.
Absolutely. Or they can talk with a housing counselor too that can help them prepare that budget if they don't know where to start.
Okay. And the housing counselors, those can be loan officers at the bank or contacting a community center that might have that also for them.
Correct. Yes.
Bank, credit unions, housing centers can tell you and help you with that. Track your
Absolutely.
expenses. Look at all those memberships that you didn't know that you were paying automatic withdrawals. Then start looking at savings and paying down your credit and your credit cards and your debt, and then your savings. Start building up a savings a little bit at a time, even $5 or $10 a week to start off, $25 a week from the paycheck.
Absolutely. All those little steps matter.
And probably I think it would be better them to get that part automatically withdrawn from their check, the savings probably.
Yeah, that's a great tip. Yes. Get rid of it and put it in a savings before you see it. Out of sight, out of mind.
Out of sight, out of mind. Okay. Well, this was a great talk. I appreciate you, Susan, from coming on to talk to us about getting financially sound during an inflationary period, what to do to still get your home, what to do to get your credit together, your budget, and get life going for you. Um, this is Susan from Newmark Credit Union in Joliet, Illinois, and also in Manuka, Illinois. I'll have our email address if you have any questions. Thank you very much. This is Why Not? I'm your host, Janice. Thank you very much, Susan, for coming on the show.
Thank you for having me.
Good night, everyone.
Good night.